The stock market. It's often touted as this powerful engine for building wealth, a place where smart investments can really pay off. But let's be honest, for a lot of people, especially if you're just sort of dipping your toes in, it feels more like trying to figure out some ancient code that keeps changing. So that's really our mission today. We're diving deep into this comprehensive guide. Think of it like key to understanding Wall Street, maybe. We want to pull out the absolute essentials. The goal is to get you informed quickly, thoroughly, but without that feeling like your brain's just, completely overloaded.
Exactly. And this guide, it lays things out pretty logically. It starts right at the beginning, what is the stock market? Yeah. And then it moves through things like investing strategies, managing risk. It really builds your understanding step by step. So you get a solid foundation.
Yeah, and we're not just reading from a textbook here. We're looking for those aha moments, those surprising bits, trying to make sense of the concepts that often sound, really complicated with all the jargon. Okay, so let's unpack this, starting right at square one. What exactly is the stock market?
Well, in its simplest form, think of it as a marketplace. But instead of, fruit or vegetables, people are buying and selling shares. Ownership in companies. And why does it exist? Well, two main reasons, really. One, it lets companies raise money capital by selling those shares. That's fuel for growth. And two, it gives people like you a chance to invest in those companies and hopefully share in their success.
Right. So companies get funding, individuals get a shot at growth. Okay. Yeah. But the actual buying and selling, that's where it gets a bit murky for some. How does that part work?
Fundamentally, it's all about supply and demand, really. Imagine a company has, say, 1,000 shares out there. If loads of people suddenly want to buy those shares, demand goes up, and the price usually gets pushed higher. But if lots of current shareholders decide, okay, time to sell, then the supply increases and the price tends to drop. These trades, they usually happen through brokers, intermediaries. And there's a whole ecosystem involved. You've got individual investors, big institutional investors like banks or mutual funds, the brokers themselves, and crucially, the regulators keeping an eye on things.
Okay, marketplace for company ownership. Prices move based on who wants to buy versus sell, and there are different players involved. Got it. Now, this whole system, it wasn't just invented yesterday, right? It has quite a history.
Oh, absolutely. It's fascinating how far back it goes. The very first sort of formal stock exchange, Amsterdam.
1602.
1602, wow.
Yeah, it was the Dutch East India Company. They were huge in global trade back then, and they started issuing shares so the public could invest in their big, risky sea voyages. Imagine that.
That's incredible. From funding spice routes back then to, funding tech giants today, or some other big steps along the way. Well, after Amsterdam, you saw other major exchanges pop up that are still massive today. London, that was 1801. New York, 1792. And the New York Stock Exchange, it actually started pretty small. Brokers signing an agreement under a tree on Wall Street, believe it or not.
Under a tree? Seriously?
Yep. The Buttonwood Agreement. And closer to home, for listeners in India, the Bombay Stock Exchange, the BSE, that's Asia's first stock exchange, established way back in 1875. Just think about the history there.
Asia's first, 1875. That really adds perspective. So for a long, long time, it was all like physical trading floors, people shouting, paper certificates flying around.
Pretty much. The move to electronic trading, getting rid of those paper certificates, dematerialization they call it, that was a huge change. Made things way more efficient, more accessible. In India, the National Stock Exchange, the NSE, really led that charge. They launched fully electronic trading in 1994. So now markets are connected globally like never before. But of course, it hasn't all been smooth sailing. You have major crashes like the Great Depression in '29, the 2008 financial crisis. Those were harsh lessons about, risk and market stability.
Definitely. Those big events really show how linked markets are to the wider economy. Now, when we talk about buying and selling today, we hear about different exchanges all the time. Can you maybe clarify the main ones, especially BSE and NSE in India?
Sure. So the BSE, as we said, is the older one in India, 1875. Its main index is the Sensex that tracks 30 of the biggest companies listed there. And here's a surprising fact. Despite its age, the BSE is apparently the world's fastest exchange. Its response time is reported at just 6 microseconds.
6 microseconds, that's, basically instant. What about the NSE then?
The NSE, the National Stock Exchange, that started later, 1992. Its main index is the Nifty 50, tracking the top 50 companies. And the NSE's big claim to fame was being India's first fully electronic, fully dematerialized exchange. Really modernized trading here.
Okay, so BSE, the veteran. Sensex index, super fast. NSE, the modernizer, Nifty 50, pioneered electronic trading in India. And what about the big global ones we hear about, like in the U.S.?
Yeah, globally, the New York Stock Exchange, the NYSE, is the oldest in the U.S. Lots of big established names listed there. Think Apple, Coca-Cola.
Right.
Then you have the NASDAQ. That one's heavily focused on technology. Microsoft, Amazon, Meta, Facebook. They're all on NASDAQ. These are really key hubs for global investment.
Okay, so we've got the marketplaces, the history, the main players. Now, who makes sure everyone plays fair? Let's talk about the regulators. Why are they so critical?
Oh, regulation is absolutely essential. You need it to keep the market trustworthy. The main goals are preventing fraud, stopping manipulation, protecting smaller investors, people like you who might not have all the info the big players do, and just ensuring transparency. Without good oversight, things could get chaotic, unfair, really unstable.
And in India, the main regulator is SEBI, right? What exactly does SEBI do?
That's right. SEBI, the Securities and Exchange Board of India. It was set up in 1992, largely because of the Harshad Mehta scam, which really highlighted the need for stronger rules. SEBI has broad powers. They regulate brokers, mutual funds, investment advisors. They approve IPOs. We'll get to those.
Yeah.
They investigate things like insider trading, market manipulation, and they push reforms. Like they recently brought in the T+1 settlement cycle. That just means trades settle faster, you get your shares or money quicker, more efficient.
So SEBI is kind of like the referee in a football match, making sure everyone follows the rules.
Yeah, that's a pretty good analogy. Referee, rulemaker, investigator, all in one.
And is there a similar body in the U.S.?
Yes, the SEC. The Securities and Exchange Commission. It was formed much earlier, back in 1934, right after the big 1929 crash. That crash really showed why strong regulation was needed. The SEC does a very similar job to SEBI, overseeing exchanges, brokers, funds, protected investors, keeping markets fair and orderly.
Okay, so SEBI in India, SEC in the U.S., their job is basically to ensure trust and fairness. That's good to know. Right, let's dig into the actual thing being traded. What is a stock? We say shares, but what does owning one actually mean?
Okay, think of a stock as just a tiny piece of ownership in a company, a fraction of the whole business. Like imagine a company's a pizza, okay, and it's cut into, say, 1,000 slices. If you buy one stock, one share, well, you own one slice of that pizza.
I like that. A slice of the pizza. So why do companies offer up these slices to everyone? What's in it for them?
Mostly it's about raising money capital. They need funds to grow, right? Maybe expand the business, research new products, move into new areas. Instead of taking out big loans, they sell off small parts of the company's future potential to investors and get cash now.
And for the investor buying that slice, what's the potential benefit?
Well, a couple of main things. First, if the company does well, grows, becomes more valuable, the value of your slice, your share, should hopefully go up too. You could sell it for more than you paid.
Okay, capital appreciation.
Right. And second, many companies pay out a portion of their profits to shareholders. Those are called dividends. So you get a share of the profits. It's also worth knowing there are different types of stock. Common stock usually gives you voting rights, a say in company matters. Preferred stock usually doesn't have voting rights, but often gets priority for dividends. But the bottom line is, a stock means you own a tiny part of that company's future, for better or worse.
Owning a piece of the future potential. Got it. Now, how do companies sell these slices to the public for the first time? That brings us to IPOs, right? What's that process?
Exactly. IPO stands for Initial Public Offering. It's when a company that was privately owned decides to sell shares to the general public for the very first time. It's a big step going from private to public.
Why do they do it? Sounds like a massive undertaking.
Well, several reasons. One, it can raise a lot of money, often much more than they could borrow. Two, going public can really boost a company's image, its credibility, make it more visible. And three, it gives early investors, like the founders or venture capital firms that backed it early on, a way to sell some of their shares and cash in on their investment.
So, big money, bug reputation, and an exit for early backers. Makes sense. What are the main steps involved if I have a private company and want to go public?
It's a pretty structured process. First, you hire an investment bank. They guide you, act as underwriters. Then you prepare a huge document in India. It's called the Draft Red Herring Prospectus, or DRHP. It details everything about the company, its finances. You file that with a regulator, like SEBI, for approval. Then you figure out how many shares to sell and set a price range. After that, investors apply to buy the shares. That's the subscription period. And finally, if all goes well, the shares get listed on an exchange, like the BSE or NSE, and start trading.
Okay, so it's like, imagine that successful local bakery wants to go national. Instead of just a bank loan, they offer everyone a chance to own a piece by buying shares in their expansion plans. That's the IPO.
That's a good way to think about it, yeah. More tangible.
And once those shares are listed and people start buying and selling them on the exchange, is that still the IPO?
Good question. No, that's when you move from the primary market to the secondary market. The IPO itself happens in the primary market. That's the company selling new shares directly. The secondary market is where all the trading happens after the IPO, between investors buying and selling the already existing shares.
Primary market,
Yeah.
company sells first time. Secondary market, investors trade afterwards. Got it. Clear.
Now, looking at all the different stocks out there, it's a huge number. Are there ways to group them, to sort of categorize them?
Definitely. A really common way is by market capitalization, basically. The total value of all company shares out there, you calculate it by multiplying the share price by the number of shares. This gives you categories like blue chip stocks. These are the big, established, financially solid companies. Think Reliance, TCS in India. They're generally seen as, safer, steadier.
Okay, blue chips, the giants, stable. What's next down? Then you have mid-cap stocks, medium-sized companies. Maybe like Dixon Technologies or Voltas. They often have more growth potential than blue chips, but maybe a bit more risk too.
Right.
And then small-cap stocks, smaller companies, sometimes newer ones like Brightcom Group or KPIT Technologies. These can offer really high growth potential, but they also come with the highest level of risk and volatility. You could almost picture it like a pyramid, blue chips at the wide, stable bottom, small caps at the pointy, riskier top.
That pyramid visual helps. So size matters. Any other ways stocks get grouped?
Yeah, you can also look at their growth patterns. So you have growth stocks companies growing faster than average, maybe reinvesting profits heavily. Think Zomato, perhaps. They're focused on expansion.
Okay.
And then you have value stocks. These are companies that seem to be trading for less than what they might actually be worth based on their assets or earnings. Sometimes a company like Coal India might fit this category if the market price looks low compared to its fundamental value.
Okay, so grouping by size, market cap, and by style, growth versus value helps break it down. Now, the big question, why do prices actually move? What makes a stock go up or down day to day?
Well, we touched on it earlier, but the absolute core principle is supply and demand.
Yeah.
Always. If more people want to buy a stock than want to sell it at the current price, demand is higher, price goes up. Simple as that. If more people want to sell than buy, supply is higher, price goes down.
Okay, supply and demand. But what causes those shifts? What makes people suddenly want to buy more of stock X or sell stock Y?
Well, a whole range of things influence that. Company performance is huge.
Yeah.
Did they report great profits? Or did earnings disappoint? That's critical. Then there's news. Any news about the company, its industry, rumors even, announcements of new products, mergers.
Right.
Broader economic stuff matters too. GDP growth, inflation figures, interest rate changes by the central bank. They all affect investor mood. And of course, big global events, wars, elections, pandemics. These can send ripples or sometimes waves through the markets.
So it's this mix of company stuff, economic data, global news. Can you give a quick example?
Sure. Let's say Tata Motors announces record profits, better than anyone expected, and says the future looks bright. What happens?
People probably want to buy it. Demand goes up.
Exactly. Investors see a successful company, future looks good, they want in. Increased demand pushes the price up. Flip side, if a company faces a huge scandal or a major product recall, investors might get nervous, want to sell. That increases supply, pushes the price down. And don't forget market sentiment, just the general feeling out there. Fear and greed, they call it. Sometimes that mood alone can swing prices.
Okay, so company news, economics, world events, plus that overall investor feeling. Makes sense it's always moving. Now, for someone actually wanting to get involved, what are the essential tools? Let's start with indices, Sensex, Nifty. What are they really?
Right, indices. Think of them as curated baskets of stocks. They pick a specific group of stocks like the top 30 for Sensex, top 50 for Nifty to represent the overall market, or maybe a specific sector. They act as a benchmark. A quick look tells you the general direction the market's heading. Are things generally up today or down?
So like a thermometer for the market?
Yeah, a thermometer or snapshot, very useful for tracking trends, comparing how your own investments are doing. And they're also the basis for things like index funds and ETFs, ways to invest in that whole basket easily. Globally, you hear about the Dow Jones, S&P 500, NASDAQ, same idea.
Okay, indices give the big picture. What about actually holding shares and trading? Demount and trading accounts, what's the difference?
Good question. They're both essential. A demat account, that's short for dematerialized, is basically your digital locker. It's where your shares are held electronically. No paper certificates anymore. In India, NSDL and CDSL manage these.
Okay, digital storage.
And the trading account is what you use to actually place the buy and sell orders. It connects your demat account to your bank account.
Yeah.
So when you buy shares, money goes from your bank through the trading account, and the shares land in your demat. When you sell, shares leave the demat, money goes to the trading account, then back to your bank.
Ah, okay. Linked together.
Exactly. You'll open both, usually through a broker. And super important, keep your KYC, know your customer details, up to date with them.
Right. Now, when I go to place an order through that trading account,
Sure.
are there different ways to do it? I hear about market orders, limit orders.
Yes, several types. The simplest is a market order. That just means buy or sell now at the best price available in the market. Quick execution.
Okay.
A limit order gives you price control. You say, I only want to buy if the price hits X, or I only want to sell if the price reaches Y. Your order only goes through if the market hits your price or better.
More control, but maybe it doesn't execute if the price never reaches your limit.
Precisely. Then there's the stop loss order. Very important for risk management. You set a price below where you bought, and if the stock falls to that level, it automatically triggers a sell order to limit your losses.
Like a safety net.
Kind of, yeah. There are others too, like stop limit, cover orders, bracket orders.
Yeah.
Those are often used by more active traders, combining stop losses and profit targets. But market, limit, and stop loss are the main ones for most investors to know.
Market for speed, limit for price, stop loss for protection. Got it. And finally, who actually provides these platforms, this access? The brokerage firms.
Yes, the brokers. They're the middlemen, the gatekeepers providing access to the stock exchange via their trading platforms, apps, websites. They open your demat and trading accounts, often provide research, market data, customer support. Some also offer margin trading, basically lending you money to trade, which adds risk, of course.
Are there different kinds of brokers?
Broadly, yeah. You have full-service brokers. They tend to offer more advice, research, maybe personal advisors. Think ICICI Direct, maybe. They often cost more. Then you have discount brokers like Zerodha or Grow. Their main focus is providing a low-cost platform for you to trade on your own. Less hand-holding, much lower fees typically.
Full service versus discount. How do they make money?
Mostly through brokerage fees, a small charge on each trade. Also annual fees for maintaining your demat account, AMC. Interest if you use their margin facility, maybe fees for premium features.
So when choosing one, what should you look for?
Definitely compare the brokerage charges. Look at the trading platforms as easy to use, reliable. Check reviews for customer service quality. And critically, make absolutely sure they are registered with SEBI. That's non-negotiable.
Right. Check the fees, the platform, the service, and SEBI registration.
Makes sense. Okay, wow, we've really covered a lot of ground here, from what the market is, its history, the exchanges, the regulators, down to what a stock represents, IPOs, different stock types, why prices move, and the tools you need like indices and accounts and brokers.
Yeah, we have. And understanding these basics, these foundational concepts, that really is the crucial first step. It gives you the framework, the context to understand everything else you might hear or read about investing.
Absolutely. It's about building that knowledge base so you can approach the market feeling more informed, more confident. Couldn't agree more. So, to leave you with something to think about, considering everything we've discussed, the history, the supply and demand, the global connections, what single piece of news, maybe a company announcement or a big economic event, do you think might have the biggest ripple effect on the market tomorrow or next week? Something to mull over as you start applying this knowledge.